Why is the market rising along with the rising COVID numbers? Many investors are completely confounded about it. In this video, I try to explain possible fundamental reasons and a little on equity risk premium, and finally how you can protect your portfolio from the next market crash. Historically, even if the near-term outlook of economy is poor, if the stock has reacted enough, it tends to bounce back sharply. You could see evidences of this in many recessions and also during 2008 financial crisis. Secondly, the objective of any central banks to pump in liquidity is so that the money gets into the credit market, thereby easing liquidity. But before that, it ends up going to the capital markets. Therefore, any quantitative easing measures or liquidity enhancement measures announced has always resulted in capital markets shooting up. The trouble though is if the money doesn't end up going into credit market and thereby pulling down the economy. RBI has cut interest rates by 115 basis points and also has pumped in over 8 lakh crore in the last 2 quarters. Third, I believe is that after a severe lockdown, economic activities are back to normal. The production levels are back at 50, 70 or 100%, and many believe that there is a medical solution just around the corner to COVID-19. So with a lot of liquidity available and real estate investment activities being very poor and very low interest rates, a lot of money is chasing stocks, thereby pushing the markets very, very high. What is equity risk premium? It is an excess return an investor gets over risk-free return offered by a government security. The investor is compensated by additional return for taking higher risk of equity investing. At Augment Capital, we use the inverse of ERP to understand relative attractiveness of an asset class over other asset classes. According to that, equity investing at these levels are also warranted. But do remember, we are still not out of the woods. Fundamentals can deteriorate very, very quickly depending on how this coronavirus spreads. So what can you do to protect your capital or save your returns before the market crashes? Many ways. Few of them are: one, stagger your fresh equity investment over longer period. Add gold, definitely add gold to your portfolio. If any of your financial goals are nearing, try to reduce your equity allocation or completely exit equity. Try and add more long dated government securities, because if economy gets into a downward spiral, the interest rates will also definitely come down, thereby giving you handsome returns. And finally, try and use equity options to hedge your portfolio completely or partially. Speak to your financial advisor to understand any further options available, or write to us and we'll be happy to help you. Hope you found this video very useful, and do share your feedback, and happy investing.